Good day, everyone, and welcome to our podcast with myself, John Nicola, and our senior investment management team on expectations for portfolios and asset classes for 2022. A few days ago, we wrote a newsletter called A Tale of Two Cities, focusing on the major theme behind that book. As you remember, the book was written by Charles Dickens, and it was about the French Revolution. And this was the great quote from the book at the beginning. It was the best of times. It was the worst of times. It was the age of wisdom. It was the age of foolishness. It was the epoch of belief. It was the epoch of incredulity. It was a season of lights and it was a season of darkness. It was a spring of hope. It was the winter of despair. So how does that apply to the environment that we're currently in? Well, let's look at it from a glass half full perspective. In terms of the best of times, public markets and residential real estate are at all-time highs in several markets. COVID vaccines have been developed in record time. The fourth wave of Omicron may have much lower levels of serious illness or death. The move to ESG investment options in light of major environmental issues such as climate change are accelerating rapidly, and the cost and evolution of renewable energy is improving exponentially. Significant drops in the levels of global poverty, hunger, and illiteracy. Read, for example, the book 10 Global Trends by Marian Zuppi. Global population increases are slowing rapidly and likely to peak within 30 years at around 9 billion. And even if interest rates do rise, they're likely to be measured and spread out over time. The impact on asset prices would likely be modest. Now, if we take a look at what happens when we think about the glass being half empty, it's a different picture. Huge increases in corporate and government debt to finance the pandemic and acquisition of assets. Good example is Evergrande, which has gone bankrupt in China, and the end result, a combination of higher inflation and corporate defaults. With geopolitical tensions such as China and the US over Taiwan and Russia and NATO over Ukraine. Dysfunctional politics and the rise of populism, especially in the US, equity prices at near record valuation levels, faster infection rates for Omicron leading to new lockdowns globally, and higher interest rates and inflation, and therefore having potentially a major impact on residential housing. So a year ago in our market outlook, we took a look at where markets were, and we wondered, where are we? Is it the bulls or the bears who are going to win? Well, as it turns out, at that time, March 31st, 2021, it was the bulls who were having a fine time of it. By that time, 1 year into post the trough of the markets in March of 2020, the TSX was up 50%, the New York Stock Exchange 61%, the FTSE 32%, even the Hang Seng was 29%, and the Euro stocks was 51%. So virtually every public equity market in the world was in significant positive territory. And what about since then? But this is the S&P 500 from March of last year to the end of the year. And you can see that even after that spectacular rise to March, it rose another 20% to a record of roughly around 4,800 towards the end of December this last year. But as we well know from today, and today for those of you who are listening to the podcast, this is being broadcast on January 24th, Monday, January 24th, where there has been a bit of a market meltdown that's continued, a drop in equity markets that's been sustained over the last 2 or 3 weeks. Since January 4th, when the actual S&P peaked in this cycle, to the 24th, the S&P 500 is down 11.7%. And what about other markets? Well, besides the S&P being down almost 12%, the NASDAQ is down almost in bear territory to 18%. The Russell 2000 small cap marketplace in the US is in bear territory at minus 21%. The TSX has fared better, likely as a result of relatively strong oil prices and commodity prices. And the Euro stocks has not had the same drop either, but of course it didn't have the same run up in prices beforehand. And meanwhile, this is just as much likely political as anything else. The Hang Seng is down 21%, so also in bear territory. So we took a look at this, and this is also a year ago. We wrote a newsletter called Born Under a Bad Sign. The idea was to take a look at what large organizations felt the future expectations for returns in various asset classes would be, primarily public equities and public stocks. So in the newsletter, we took a look at the return expectations. So these are the 10-year return expectations for the following organizations. You've got BlackRock, JP Morgan, Morningstar, Research Affiliates, and Vanguard. So major asset managers. And their predictions for returns on average for US equities was 3.14%, higher for developing markets and negative for bonds as a result of potentially higher interest rates. When we put all of that together, we could take a look at what $1,000 would be worth in US equities, in developed market equities, and so on and so forth, and put it together as a portfolio. In other words, assuming 75% of the portfolio was in equities, that is emerging, developed in US, and 25% in bonds, and deducting for fees, modest fees, and inflation, the actual 10-year return expectation of this entire group is 1.28%, far less than we've experienced in the last decade. And this is also supported by another study by Credit Suisse, which came out just a few weeks later, and their expectations, which are on the far right, what they call the Gen Z predictions for the future, show a 2% balanced rate of return, net of fees and inflation for the next decade. So consistent with what we saw with the other groups. When we take a look at where things were by the end of 2020, early 2021, the stock market, and this is the Wilshire 5000, so that's the broadest basket of stocks in the US, was at a multiple of 1.72, or the highest it had ever been in its history as a percentage of GDP. That was a record. Interestingly, as things have gone on, the S&P 500 also hit some records in terms of its price earnings ratio, but, and this is a really important but, even though the S&P 500 is not inexpensive, it is 35% lower today as a PE multiple than it was 1 year ago in January 2021. So does that mean then that a significant correction has already taken place? This drop in the PE ratio is a function of both, in this case, a small drop in prices, but mainly a significant increase in earnings without prices rising at the same rates. And when we take a look at something else, so sometimes a way of measuring value is to take a look at the yield. In this case, the yield on the S&P 500. And the yield on the S&P 500 is very simply this. You just basically take the inverse of the earnings. So essentially, if the PE ratio is 25, that means then that they're earning $1 of profit after tax for every $25 of price, or that's a 4% yield. And that 4% yield is actually 130% higher than 10-year bonds. So even though that yield is not as high as it historically has been in the past, in relation to the rate you can get on 10-year bonds, it's actually quite reasonable. The other thing that's occurring is this, is that the American markets definitely have had a higher increase in valuations than other markets. So when we take a look at the US stock market PE ratios, this is over a 10-year period of time, in the orange, they have separated themselves from the valuations for other global marketplaces. So just because stocks are expensive in the US does not mean they're as expensive in other markets. Another issue is that, of course, people are concerned that rising interest rates will have a negative impact on real estate, and in particular cap rates, or the income rates of real estate. And it is true that, in fact, the rising interest rates would normally lower the cap rates, or raise the cap rates of real estate, and therefore lower prices. But the interesting thing to remember is that when we compare 2007 to 2021, we see that the actual spread, the difference between bond rates, government bond rates, and the cap rates is pretty well the same. It's within a 0.5 percentage point. So it really has not dramatically changed. So this will come down to what happens to future interest rates. Are they going to rise? And if so, by how much? And that comes down to some degree to the inflation story. Inflation has risen certainly significantly in both the US and Canada. But the question is, has it peaked? Well, it's hard to tell, but as of this morning, the bond rates in the US were the same as they were in April of last year. In other words, yes, they've come up from the lows that they had in the late fall and the summer, but they are not higher than they were last spring. So if we take a look at specific interest rates, even though again we're talking very low interest rates for 10-year bonds in Canada and the US, take a look at how it compares to other countries. In the US, we're currently at 1.72, Canada 1.74. Greece, which is nowhere near the credit rating that the US or Canada have, is cheaper to borrow, as is the UK. Japan is almost at zero, Switzerland is below zero, and Germany is minus 0.11%. So by any reasonable standards, North American interest rates aren't that low in comparison to the global peers. Let's take a look here at the inflation figures. Year-over-year inflation in the US is at 7%. So that's the highest it's been in 30 years. And the same is true in Canada. The number is smaller at 4.8, but that is also the highest in 30 years. But there are a couple of other things to consider here. Is inflation rising? Well, for starters, we had low levels of inflation in 2020. The US was 1.2 and Canada was 0.7. So interestingly, when you start to actually average this out over 2 years, the rates are significantly lower. A lot of this is driven by supply chain issues, huge increased demand from government support that has been provided, basically flooding the market with cash. So we have to ask ourselves, is this permanent or transitory? Has the trend turned? And as you can see, there is some sense that maybe you're seeing a rate of decline that is going to bring the weighted inflation numbers down as we go through 2022. So glass half full or glass half empty. This comes down, and I think to a large degree, to asset allocation, because one of the ways to control volatility or actually not have to worry so much about predicting market outcomes is to get the asset allocation right. So this is what it looks like generally for us. This is in the broad picture, and you can get this detail from our website as well. So roughly speaking, we allocate 35% of our clients' capital to public and private equity, 30% to income producing real estate or development real estate, and 35% to private or public debt, and then rebalance on a consistent and regular basis. So how well has this worked over time? Again, this chart is available on our website, but basically it compares the returns our clients have earned over the last 22 years to other options that they would have been available to them. So if we had put for the last 22 years all of their capital into global stocks, so no bonds, just 100% into global stocks, their returns would have been 5.43%. If it had been in the S&P 500 in Canadian dollars, 6.75. If it was in the TSX, slightly higher at 6.87%. If it was in a normalized balance fund, this would be typically a funds that generate about a 60% equity position, 40% fixed income. And the average for Morningstar's Canadian neutral balance portfolios is about 4.85%. You'd expect it to be lower than 100% equities. But our client's return was 7.08%, still maintaining a balanced portfolio. And in fact, if we take a look at this works out to be 30% less volatility and a very significant difference in actual rates of return net of all costs, more than 2.2% per year. So with this, what I'd like to do is turn this over to our investment management team, made up of our Chief Investment Officer, Rob Adel, our Managing Director for Private Capital, Michelle Patel, and Managing Director for Real Estate, Mark Hanna. So let's start, Rob, by handing this over to you. And given the context of what we're looking at here, where do you think all of this goes for us and what should happen?
Thanks, John. I like the way you've laid out the Tale of Two Cities. Another way of looking at it is one used by Michael Wilson, who's the chief strategist at Morgan Stanley, maybe less of a Dickens fan. And he uses the sort of the term fire and ice. And what I'm going to do, I'm going to start off with some fire, and then I'm going to end off with a little bit of ice. So if we look at this first slide showing the S&P 500 over the last year, you can see actually from the pandemic low, you can see the market as of the end of 2021 is up over 100%. So a lot of fire we've seen in the market, not just in equities. And when we look at the equity market, it was up a lot. But the other thing that was interesting about what we've seen in the market is we've seen very little drawdowns. So investors have been taught to buy the dip. And in fact, normally in a normal year, you'd see the S&P would have a drawdown at any particular point of about 11%. Last year, it was only about 5%. So we've seen very strong markets. Why is that? There are two big things that was driving the markets. One of them was fiscal policy. We're not going to talk as much about that. The other is monetary policy, what we're going to talk a little bit more about. And that was one of the big drivers on the market, because when you see and you look at that March 23rd low, the turning point was almost coincidental when the Federal Reserve came in and announced unlimited quantitative easing, bond buying, and they ended up within a short period of time buying about $1.5 trillion of treasuries and mortgages, and then went into a more consistent pattern of 120 billion a month. And you can see in line that strong correlation between that monetary policy and that quantitative easing in what we've seen in the market. The other thing, the pandemic, certainly that's an overriding issue that we've seen in the market. And when we look at how that's impacted the market, again, you see that turning point when the Fed started with the quantitative easing. But here, this line here is showing when Pfizer came through with their vaccine data, showing that it looked like a vaccine was very possible. And the difference is, look at the volatility in the market before the vaccine data and after the vaccine data. The market was still going up during this whole time period. It turned around with that quantitative easing, but the volatility of the market was largely eliminated because the vaccine took away that left tail risk in the economy, in the markets. And that's what we're seeing going forward. With the pandemic, even with the Omicron variant, the market's really moved on because we have that vaccine data. We know there's going to be an end to this, and the market is moved on. Now, not just equities that have been expensive. This is showing a very long-term view going back to 3000 BC of interest rates. And you can see interest rates are at the lowest they've ever been. So bond markets, fixed income markets, also extremely expensive. Credit spreads, so in the high yield bond market, corporate bond market, also very expensive. In the high yield market, you have an average credit spread. 5-year has been about just under 4%. You can see the low was about 2.6%. We're well below that 5-year average. We're closer to that 5-year low. Credit spreads are extremely tight. The high yield market is extremely expensive. Now, as far as stocks, again, very expensive. And John went into talking about some of the valuation metrics you can use. The Cape-Shiller is a good one to use. It uses cyclically adjusted price earnings multiple over a 10-year time frame. You can see that blue line almost 40 times. The market hasn't been this expensive based on the Cape-Shiller numbers since the tech bubble. Even more expensive than you saw in 1929. The key, though, and again, John alluded to this as well, look at the red line and look at, that's 10-year bond yields. So yeah, the market's expensive. That's an environment of lower and lower interest rates. So if we look at, and this is showing that equity risk premium John was alluding to as well, take the equity risk premium, you take off the 10-year treasury yield. So you're looking at the sort of the spread over treasuries that equity is going to earn you. The market doesn't look so expensive. In fact, it's actually fairly attractive. Bottom line, stocks are expensive, but not relative to bonds. It becomes this issue of stocks being the only sort of game in town from an investment point of view. Now, what does this mean going forward? Because if you're predicating your value proposition on stocks on low interest rates, they better stay low or you're going to have a problem. And that is what we're faced with, going forward. If you look at and this was a survey asking fund managers in the US what they view as their biggest tail risk, biggest risk in the market in December, hawkish central bank hikes in inflation, higher interest rates that impact that's going to have on valuations, taking away, that advantage over bonds that equities have. Now, because the Federal Reserve, it looks like they're going to hike, I think a lot of people now are of the view that that could be 4 times in 2022. The Federal Reserve could increase rates over 1%. And you can see that progression over time to where we are right now. So that 1% or 4 hikes in 2022. The other thing they can do, however, in addition to raising rates, remember that quantitative easing they were doing and building up their balance sheet? They went at it, over the last couple of years, $4.5 trillion. They've doubled the size of their balance sheet. They can start tapering and then reducing the size of that. And you can see from Goldman Sachs, they have various estimates on how aggressive they think the Federal Reserve can be in reversing that increase in their balance sheet. So both of these together is tightening monetary policy. Now, that's important, and why they're doing it is because of inflation. And we can see, that the CPI numbers, as John talked about, 40-year high in the US, upwards of 7%. So we've seen an increase in inflation. But if you look at, this is from the San Francisco Fed, the blue line is showing a basket of goods that is COVID sensitive. In other words, goods and inflation that is likely due to COVID. And that's what's really driving that number. However, the white line, the non-COVID sensitive, not nearly as high, but you've seen it move higher. But overall, this idea that inflation is COVID related and we shouldn't overreact is a valid concern. However, when we look at whether it's transitory or persistent or permanent, we can see that one thing to consider with CPI is that when you look at that overall inflation amount, housing has not really been in the numbers as much as it will be in the future. And housing is a large component of CPI. So as rents start to increase and you start to see that become more of an issue, because we've seen housing prices go up quite a bit. We would expect rents to continue to move higher. That's going to be a tailwind to higher inflation. The other thing, though, is that when we look at this, there are different metrics we can use to show this, but the issue is inflation. Yes, it was driven by these COVID sensitive areas, but it's broadened. And this is from the Cleveland trimmed. They take away the top 16 and the bottom 16, highest and lowest inflation metrics. You can see that number has moved higher. So the concern would be that the longer you go with this higher inflation, be it COVID or something else, the more it gets ingrained into the economy and becomes more persistent. And so that would be a concern. We think that the other thing to watch, housing is one thing to watch. The other thing is the labor market and the concern that you're going to have this wage price spiral. And we've started to see some of the signs of that. We've seen a lot of people come out of the labor market. One of is more people have retired, but there's also more people changing jobs. And so this has put an upward increase in wage growth. And this is something that is likely to continue. Not a bad thing. This is something that we wanted, especially in the lower income areas, which is where we're seeing it. The thing, though, what's interesting is that after inflation, you can see with that sort of red line, wage earners are actually, falling further behind. And so inflation, it becomes more of a political issue, and wage growth becomes even more important, and you need more of it in order to keep up. And that's that wage price spiral that you would worry that would start to get ingrained. Now, that's the fire part of it. And that's why the Federal Reserve is needing to act. It's a view that they are behind the curve, and they need to get, react more strongly to inflation. But what's interesting is this reaction in the bond market is, as John talked about with 10 years, we're not seeing what we would expect to see given everything that's happening. The 2-year yield, you can see how that's moved up in the top part of the chart here. We'd expect that because the 2-year is very sensitive to what happens with people's expectation on Fed funds rate. But the 10-year was basically flat for a long period of time. Only just recently have we seen it move up, and now it seems to actually be backing off again. If you look at the slope of the yield curve, which people talk about, take the 10-year minus the 2-year, we would expect that to be steepening in this environment, but it's not. It's actually flattening. And the real conundrum is, why is the 10-year not going up? If the economy is so high and inflationary expectations so great, why are people and investors not demanding a higher term premium in the 10-year bond rate? And so that's a question, because the answer is the ICE part of the argument, that maybe the economy isn't that strong. And we see a bit of signs of that. We saw some weak retail numbers in December, and consumer sentiment has been falling off. Why is it falling off? Pandemic is part of it. Another wave, the Omicron, yes, but also inflation. Inflation hurts consumer sentiment. It hurts retail sales. Why? Because, yeah, you're getting higher wages, but your real increase after inflation isn't that great. The thing with stocks, though, and we talk about, again, that valuation aspect of it, the key is earnings growth. And so you can have higher rates, and that can flatten valuations as long as you have higher earnings growth. And in fact, in the past, and you can see this just from Scotiabank, just look at the red line. That's showing the S&P over past Federal Reserve interest rate hikes, how the markets perform. And it's typically done better. It's been positive. Why is that? Higher rates, sure. Why are you raising rates? You're raising rates because the economy is stronger. That's good for stocks. It's what you don't want is too abrupt of an increase in interest rates if it goes up too much too soon. Same thing here from Strategas, showing that over the ensuing 6 months, markets usually higher. So higher interest rates, tighter monetary policy in the initial phase of the cycle is actually good for stocks. And again, and this is why, because what we're looking at, the bottom line, the sort of the lighter green line, is showing forward earnings, P multiples. And over the last couple of years, they haven't moved higher. What has moved higher and what's driven the S&P 500 higher is earnings growth. That's where you're going to get the move higher in the market. How is that looking? Just look to the right. This is from CIBC. It's showing that earnings growth next year is going to be about 9%. Now, 9% is still pretty good. With no increase in valuations, if you get a 9% return, it's not as good as we saw last year, where returns were upwards of almost 30%. It's still a pretty good, decent return. The other thing, though, is that's the overall market. Let's drill down below that in how you should be positioned by both within a market, but also by geography and style. And so this is a graph prepared by Sanford Bernstein. It's showing you that where the valuation and overvaluation is in the market, it's in the longer duration assets. So you can look at stocks like you can look at bonds, short and long duration. A long duration asset is a company that is more of a growth stock, where the earnings are further out into the future. That's where you had the overvaluation. This is from Goldman Sachs. And from a sector and style point of view, if you believe that inflation is going to be higher, these are the sectors you want to be in. So financials, energies, industrials, materials, these are the more cyclical areas. They have less valuation and they have pricing power. So when you're looking at an equity, you want in an environment, if you believe you're going to have higher inflation, you want to have a company that is a quality company and is able to increase prices and pass that on, and it has pricing power. And in this environment, equities can actually be a very good inflation hedge. From a geography point of view, where are you finding a lot of these companies? Canada is a pretty good place. We are indexed. We have a lot of commodities, energy, financials. So, we think Canada is very well set for a higher inflationary environment. We also think ex-US. So, US is dominated by technology and some consumer discretionary companies. Europe, Asia, lower valuations and more exposure to industrial type names that we think will do better in this kind of environment. So with that, I will pass it back to John.
Thanks very much, Rob. That was really good stuff. And for those listening to the podcast, we're going to have a Q&A, an open Q&A amongst with me and all three of the presenters at the end. So I'm going to hold my questions for Rob in advance. And then right now, I'd like to pass this over to the Managing Director and our CFO of Nicola Wealth Private Capital, Bijal Patel. Bijal, over to you.
Thank you, John. First, I wanted to just cover off what is private capital within the context of Nicola. We've got 6 different funds within the private capital universe. It's about $2.5 billion in AUM. The biggest fund is the private equity fund. The newest fund is the venture cap fund. That's why it doesn't have any returns or investments in the year. But we've got a broad mix of spectrums within the funds. We go from private equity, which invests in private companies that are cash flow producing. We've got private debt, which focuses on the mid-market companies. Infrastructure, which is a relatively new fund, focuses on real assets. And then we've got 2 commercial mortgage funds, which focus on giving real estate debt to Canadian companies. You can see by the year-to-date returns, we had a very strong year in 2021. Private equity had a return of about 25%. That's not typical for that type of asset class. Usually we ballpark between 10 to 13% as a typical performance year. Private debt also had a very strong year at 11%. Again, that's higher than what we normally have. We normally try and ballpark around the 6 to the 9% return level. And then infrastructure mortgages, those are much steadier funds. They produce those types of returns on a year-in-year basis. 2021 also saw tremendous growth in terms of the investments and the growth in the AUM. We were able to deploy almost $850 million across all of those funds. And then the last thing I would just highlight is, the first 2 funds, venture capital, private equity, are more focused on capital appreciation. The latter 3 funds are more focused on income producing and cash flow to investors. So when we look at the value proposition for private capital pools, we look at it in 3 different ways in terms of how our pools are different than investing directly into private markets for high net worth clients or institutions. The first thing that's different about us is diversification. Most times you invest in private markets, you don't get the diversification that our investment pools offer. You've got to do an investment one at a time in terms of private companies or mortgages. Our pools, once you invest in the pool, you get immediate diversification within all of the assets within those pools, all of the investments. So you literally get hundreds of companies within your investment pool right away from day one. The other thing that's different is minimum thresholds. Usually in the private market space, to be able to access it, you've got to invest $1 million, $2 million, $5 million, depending on the closed-end pool that you want to invest into. With our asset pools, there are no minimum thresholds. So you can invest lower dollar amounts and get monthly access to those pools. And then liquidity. Usually with private market pools, there's very little liquidity. With our investment pools at Nicola Wealth, if a client's asset allocation changes it down the road, we offer liquidity so they can redeem out of that fund and change their investment asset allocation. And then you combine all of that with what we do, and we believe there's excellent return upside within our pools. I'm going to highlight a couple of trends that are going on in 2 of the larger asset categories. The first one's private equity, and then later on, I'll cover off what we're seeing in private debt. As you probably come to understand, lots of activity inside the private equity space. You can see that from 2010 up to 2021, it's basically doubled. And in 2021, there was a record level of deals, exits by companies for a combined 1.2 trillion, which was 50% higher than in any previous year. You can see it was following a pretty steady uptick with a slight downturn during the COVID timeline, and then it's accelerated past that. We think that this trend will continue, and I'll walk you through some assumptions that we're using in terms of market growth. 2 other trends that we'd highlight in the private equity space are, if we're wondering why so much investment going inside private equity, the first reason is the number of companies worldwide has grown quite a bit. And if you look at the number of listed companies that are on public exchanges, that's decreased. So there's a lot more companies that are staying private and remaining private for longer periods of time. And to get access to those types of companies, you've got to invest in the private market space. This has led to higher leverage buyout multiples. So you can see back in 2004, the multiple used to be about 8 for a typical buyout, started going up with the global financial crisis, reset back down to about 9, started a nice path to get back up, and in the past couple of years has gone up even higher than that at 13. John and Rob have shown you some slides in terms of what public market multiples look like. They're higher than this. If you make some adjustments, you can get closer to the public market comparables, but we still feel that there's value inside private market investing and an opportunity to buy at a little bit better price point. In terms of trends to watch and where we see assets under management for private equity space going, you can see back in 2010, it was about a $1.7 trillion space. It's gone up to about 4.5. During the COVID year, it kind of stayed about flat. We think for the next 5 years, the CAGR in this space is going to be 16%. There's a lot of money still flowing into it. Again, the private companies, there's a lot more of them. There's a lot more access to this type of market. So you're going to start seeing retail investors starting to go into this market. And I think that'll continue to propel growth in terms of people wanting access to AUM within this space. There's a few trends that we'll watch out for in terms of what's been driving the increase and will it continue. Tech has been an obvious player for a lot of private companies and a lot of investment space going inside there. We've seen some pullback in the publics. So let's see what happens with the private space, whether there's a little bit of pullback in tech investing in private markets. ESG is another interesting thing to watch within private markets. Within private markets, you've got perhaps greater ability to influence it, given the fact that you're taking control positions in companies and you're holding on to these companies for an extended period of time. So you've got more capability of influencing companies and their ESG policies and philosophies and framework within the private market space. So that may accelerate more demand as well. As I showed you earlier in terms of price valuation, it's definitely a seller's market in terms of multiples. Will they continue to have pricing power? Will the recent fall off in public markets influence it at all? It's a trend that we're going to continue to watch. And then private equity growth and demand for private debt. A lot of the private debt growth, which I'll walk you through, has been on the back of private equity fundraising and investments into their private companies. So that's another trend that we'll watch to see how it plays out, and it'll have a knock-on impact in terms of private debt growth. So in terms of private debt, the second category I wanted to walk you through in a little bit more detail. The two charts I'll show you are, where the risk-free rate is and where broadly syndicated loan premium is, and then the direct originated upper middle market loan premium. The broadly syndicated loan premium stayed about the same. It's this blue bar here. It's about 4%. What we've noticed is the directly originated upper middle market premium. It's gone up by about 100 basis points. It's now 260 basis points higher than broadly syndicated loans. And it's offering us an opportunity to pick up extra yield because these areas here are the sweet spots that we play in. So we've seen more opportunities to try and pick up a bit more yield, and that's benefited our book. The other thing we've been doing is focusing more and more on floating rate instruments. The market by itself tends to be floating rate, but with inflation on the rise and markets calling for higher rates, we are positioning our book to be much more floating rate as we can. In terms of how the growth has been here, really the private debt marketplace exploded after the global financial crisis back in 2008. Banks started pulling out of a lot of lending to mid-market companies, and private lending became more popular. It's grown at a nice trajectory. During the COVID, it flattened out a bit because of economic uncertainty, but it didn't go through a down period. It grew a little bit, and now we continue to see it growing at about 11% CAGR over the next 5 years. So we think there's lots of opportunities still untapped in the private debt space. And then in terms of things that we look for, risk points and how we think we need to position ourselves, there's really three big risks over the next few years that we'll watch out for. The first one is high valuations, which I showed a chart walking you through that. So what do we do about that? We really partner with strong sponsors who have purchasing power, who can try and drive down the price as much as they can. We also do it in a variety of ways. We do primary investments directly with the sponsors. We do secondary investments where we can obtain a bit of a price discount and see through some assets and pick specific industries that we like. And then we also do a lot of co-investments, which come with reduced fees, which also help to level set the higher valuations and still earn strong IRRs. And then we also look at non-cyclical industries. So we look for cash flow producing businesses that don't have a lot of cyclicality to it or government regulation risk. And we think if we do have to pay a little bit higher for those industries, those will survive stronger over the long run. And then we have conservative underwriting too. We downcase all of our investments before taking a deeper look at them. We've got an experienced investment committee with external members with decades of experience who've gone through lots of cycles, and they help us make sure that we understand what can make this transaction go bad and are we well positioned if it does go bad. The second area that we spend some time reviewing and thinking about is rising rates. So as I mentioned, we've been positioning our books in private debt to more floating rate loans. We've been doing the same thing with our mortgage book. It's gone shorter duration, more floating rate. In the event that rates start rising, we won't be locked up with lower coupon instruments. And then again, cash flow producing businesses. So as Rob mentioned, if rates do go up due to economic booms, then these businesses that are already cash flow businesses should be able to withstand any higher coupon payments they need to make. And we think that's important for our book. And then the third thing that we watch out for are economic cycles. The best way to watch out for economic cycles really is to have a very diverse portfolio. We hold no more than about 4% in any individual investment with any of the pools. And we have stated criteria across which we diversify across industry, sectors, geographies, and we manage very tightly with that. We review that with our investment committee on an ongoing basis to make sure we're well positioned for any economic cycles. But again, because we try to focus on non-cyclical industries, conservative underwriting, strong sponsors, we think that we position ourselves well for any downturns as and when they happen. So with that, I'd like to turn it over to John now to introduce Mark.
Thanks very much, Bajel. It was very interesting and very insightful. Let me now pass this over to Mark Hanna, our Managing Director of our real estate group, and somebody who has a wealth of experience in both good and bad markets in the real estate sector. Mark, over to you.
Thanks, John. I guess last but not least, I will speak about our three open-ended evergreen real estate funds. 2021 was a record year in terms of volume for our Nicola Wealth real estate team. We closed on 75 transactions totaling 1.9 billion in gross asset value. We also had another 21 transactions that totaling 500 million that are firm, but they've carried over into 2022, and they're going to close in the first quarter of this year. This first slide illustrates the returns for all three funds. So on the left-hand side, you've got NCRE, that's our Nicola Canadian Real Estate Income Fund. You see it's at 17.2 as of November 30th. And then underneath it, you have our NUSRE, that's our US Income Fund, 9.7 year to date. And then underneath is the NVA, the Nicola Value Add Real Estate, and that's at 11.9. We expect our numbers in the coming days for December, which will allow us to then record our year-end results. But you can see what our projections there. We're pretty confident it's going to end up either at or higher than those numbers. So gross asset value for all three funds, when you convert it to Canadian dollars, we're around 6 billion total and about 3 billion net asset value. So the primary objective of our Nicola Wealth real estate team is to build and manage our three real estate funds in diversifying by asset class and geography. So since the start of the pandemic, COVID in Q1 of 2020, seems like years ago, our team gained valuable knowledge on what assets and geography perform well and which ones struggle in a stressed environment. Fortunately, our strategy of singles and doubles has paid off. So in terms of asset classes, what we learned is that industrial, multifamily rental apartment, creative office buildings, and self-storage, they proved to be very durable. We have a strong position in all these asset classes, and that's really why our funds have performed so well. The asset classes that struggled were hotels, enclosed shopping malls, and certain types of high-rise office. Fortunately, we do not own any of these assets. So in terms of geography, our strategy is really to focus on major cities and strong secondary markets that feature strong employment growth and low vacancy rates. So going to our next slide. So for Canada, we've got a good representation in many cities, major cities such as Vancouver, Toronto, Montreal, Winnipeg, Victoria, Kelowna, and even Calgary in terms of industrial. So on this slide, you can see we've got different asset types. You got the apartment buildings, industrial, self-storage, and creative office, and of course, across the country. For our US fund, for our commercial assets, the geography means Seattle, Las Vegas, Phoenix, Denver, Dallas, and Minneapolis. And then for our very large residential portfolio, rental apartment portfolio that we have with Venterra, that is in the South and Southeast US markets. For our value add fund, this fund was started 6 years ago. This is a very unique open-ended evergreen fund in North America. Currently, we have approximately 70 projects that total over 600 million. This fund works on both sides of the border, and it operates very differently than our two income funds. The value add fund is really a pure merchant fund where we either build to sell or repurpose and sell. We typically align with experienced partners who are really good at certain disciplines. This would include small bay industrial strata, wood frame, apartment buildings, creative office, land entitlement, industrial for lease, or residential condo. It also includes acquiring large portfolios and then repurposing and selling the pieces. The key is to really select top quality partners that we can scale up with, who concentrate on a specific geography or asset type. We also developed a build to hold strategy a number of years ago. So while we have a strong track record of buying existing assets where we can apply our value add strategies to grow revenue and increase property value, it's very difficult to acquire brand new shiny assets where the work has already been done by somebody else. So acquiring new product on low cap rates it's really difficult to make the returns work for investors. And this is why we made the conscious decision to pursue our build to own strategy, where we can acquire land and build the product at attractive returns with minimal risk. These outcomes will provide significantly better returns where we can create the value. In order to execute on this strategy, we have built an in-house development team of experienced specialists to either develop on our own locally and or in concert with other valued partners in other markets such as Toronto and the Western US. We envision this strategy to continue in the future, where we can build new industrial, multifamily rental apartments, self-storage, and creative office. Here's an example of our build-to-own strategy, one building that we're very proud of in Mississauga. This was just completed in Q2 of 2021 with our partner, First Gulf. We built a 275,000 square foot new state-of-the-art distribution building. We had 4 offers from tenants who wanted the whole building. We decided to be a little bit patient, and we ended up getting Amazon for the entire building on a long-term lease. This last slide is a sample of some of the strategies that we've used in our value add fund, and one in particular we are very proud of, which is the small bay industrial strata product. We've done many of them, but in particular with PC Urban, and we've branded it as Interurban brand, which has become well known. in the marketplace. And I think we're on to our 19th or 20th small bay industrial strata project in Canada. And with that, I'm going to turn that back to John.
Thanks very much, Mark. And so if I might, now that we have gone through the formal part of the presentations, I'd like to put some questions to our distinguished panel here related to some of the topics that they've already raised. So let me start maybe with this question. So over the last couple of years, a lot of factors have kind of supported asset price increases. It's almost like whether you were in public equities, a fixed income, or in real estate, you had the wind at your back. Well, we're into 2022. We've got a very wobbly public market situation currently. Some interesting things potentially going on in relation to the rate of inflation changes and maybe even economic growth. So given you can look at it from the perspective of today, what's the impact you see going forward on interest rates and inflation? In other words, do you have any feel for what you would expect the year to end like for both interest rates and inflation? Rob, maybe we could start with you.
Well, I mean, I think what's tough is trying to forecast inflation. I think, a lot of people have got it wrong. A lot of people have got the 10-year bond yields wrong. You'd expect that to be moving higher, and it hasn't. There's a lot of things that components that go into inflation that make it hard to predict. What I would say is that over a longer time period, we are starting to see some more secular changes that would make one think that possibly that you will have a reversal of that long trend we've seen since the 80s of lower inflation. Now, one thing I would point out, John, you had a slide showing valuations and 10-year projections of returns, which I think, from a reversion to the mean point of view, I think is very true, that based on where we're starting with valuations, it's going to be hard to get the kind of returns we've had. The one thing I would point out, though, is in the short term, that doesn't necessarily have to happen. In other words, valuations are a poor predictor of returns in the short term. And my point, what I was trying to make in the presentation, is that unless you have a very strong reaction by the Federal Reserve, unless inflation continues to surprise to the upside, and the Federal Reserve has to really increase and tighten monetary conditions, equities can do very well in the short term. I think it's longer term where the headwind that you refer to comes into play a bit more, and it is a harder environment to get higher returns. The thing for us, though, I think this is where active management comes into its own versus passive management. And there's a correlation between the rise of passive management and declining interest rates. And if we see a reversal of that, good companies, that are able to differentiate themselves is going to become more important, and that helps active management.
Okay, thanks, Rob. So, Mark and Michelle, any thoughts that you two have, and maybe we could add to that. We know that Rob is looking at a more defensive position, that is to say, focusing on dividend growth, cyclicals, financials, things like that, to be maybe more important in this environment. Is there any equivalent in both real estate and private assets that you're looking at, and do you have your own opinion about your expectation for interest rates and inflation this year? Let's start with Mark.
Thanks, Sean. Yeah, I think we've been spoiled for the last few years, at least for real estate, in terms of having a relatively stable environment for both interest rates and inflation. I think what we're also seeing is supply chain is being severely disrupted, whether it's through trade wars, climate change, COVID. So there's a lot of factors that are impacting our day-to-day that we see going into 2022. So, with all these things said, we're not going to hide and close up shop and stop buying properties. I think we got to still continue to find opportunities and we can in all market environments. And we watch these market and economic trends closely, identify future threats, but future opportunities. What we are doing is we are always looking to de-risk our assets at all times and not get greedy. So, for example, if there's a lease that we have a chance to do on a property, we're gonna do it versus trying to, we always like to try and push for that higher rate, but we also want to make sure we're not left at the altar. In terms of financing, something that we're being very proactive on is we've got a very experienced 3-member team that is dealing with our debt on our portfolio. Because a big part of our getting the leverage returns for our clients is debt. So they coordinate the procurement process on a very high volume of acquisitions, as I mentioned, for new acquisitions, renewals of loans, and construction loans for our build to own, or even for our build to sell program. And so with the anticipated threat of interest rate hikes in 2022, what that team has done is they've adopted an aggressive strategy to identify opportunities in our portfolio where, say, perhaps our leasing team and asset managers have already executed on a value add, which has resulted in higher income for that asset, which now makes it appropriate to refinance perhaps 2 to 3 years in advance of the scheduled loan maturity. So we're doing that now through our entire portfolio. So because our goal is we like to try and maintain that, if we can, that 200 to 300 basis point spread between the cap rate and the interest rate. Over the past several years, real estate has really benefited from a record low interest rate environment. And we are anticipating that we're going to be facing a challenging environment over the next 1 to 3 years with rising rates. Cap rates will adjust, but our experience is the markets typically take 3 to 6 months to adjust.
Right. Thanks very much, Mark. So, Michelle, let me turn this same question over to you, please.
Yeah, thanks. From our point of view, I don't think we're trying to win or lose based on where interest rates head. We'd probably think intuitively they're probably going to be higher than where they are now, but we focus our investment decisions on the same 2-3 things that we always do: cash flowing businesses so that they can withstand short-term shocks. We also focus on investing with key partners and sponsors who have deep pockets, who have the ability to go in and help companies do some value add creation and build up the business to greater earnings generation. And we always try to drive fees down wherever we can. So if there is a period where IRRs are going to go down because of different economic cycles, then we try to drive fees down as much as we can with our partners to help our clients out.
Great, thanks, Michelle. So maybe here's a broader question for all of you. It's hard to know based on the early part of this year in terms of what we're seeing as a market correction. But let's say, for argument's sake, that the market correction morphs into a broad-based bear market in most major public markets, and in addition to that it becomes a precursor to us moving into a financial recession. How would that change the view that you have in the way you would choose to allocate resources and choose investments? So, Rob, do you want to start with that one?
Well, I think we, from a style and portfolio point of view, we have managed the portfolios with that scenario in mind. So we are more defensive. We have not bought the higher valuation stocks. I think from a fixed income point of view, we've not had high duration. And that would be something to think about in that kind of environment, that maybe you'd want to think about taking more duration if you thought interest rates would move lower. We just don't think you're compensated to take that risk. And from a credit point of view, and a lot of our external managers, that third-party managers that we use in the credit space have been defensively positioned. So I think from a relative point of view, we would look and do very well. It's the environment you've laid out is not our base case, and it is one that other than holding cash or funds that are able to have a very uncorrelated or even short, risk assets, it's hard to avoid, entirely that environment. But I think, from a relative point of view, that we are pretty well positioned for that kind of environment.
Okay, thanks, Rob. So, Mark, any thoughts about the bear market scenario and the recession scenario? Does that change anything that your team would be doing or looking at?
It does, but our real estate team is, we're very disciplined in terms of the kind of markets and asset classes that we want to pursue, and I don't see that changing dramatically. I think what we always look at is when we're acquiring a property, is we look at the in-place rents. What's the vacancy rates for that market? Is there good job employment? Are the bones of the building good? Is the utility, the space good? So that if we do hit a major storm, that our asset is well positioned and it'll be the last to suffer versus, say, a secondary, tertiary market. So our focus will always continue to be on the property value preservation and the income preservation. And one of the things that we've been doing for many years is when we do a lease transaction, we, if we're doing, say, a 10-year lease, we will implement 3 to 5% annual rent escalations, so that in a way it serves as a counterbalance to rising rates or falling values. So that has served us well, and we'll continue to adopt that strategy.
Great, thanks, Mark. Bijal, how about you?
Yeah, at a macro level, I think we're well positioned. The types of companies we've always invested in, which are cash flow producing, should help us. We haven't been heavy in technology, so we're less exposed there. You look at private debt. Most of the deals there we're doing are with PE sponsors who have deep pockets, long track records. They've got long-term horizons and that can withstand a short-term recession. We're also got capital preservation in those books because we rank ahead of equity and public debt. So we feel well positioned there. On the private equity side, we've got a mixture of investments that we do. We've got a few sponsors that we like to select. We've got a mixture of secondaries, co-investments, where we can decide which sectors, industries are more recession-proof than others and go deeper in those and stay away from the ones that are maybe more cyclical. So I think we're well positioned and not at a major risk there. On mortgages, we've been very conservative. What we do in the mortgage business, it's relatively low LTVs, lots of room there for some compression and still an ability to work through the situation. And then infrastructure by its nature generally is more recession resistant. So that's, again, the smallest portfolio, but it's one that over the long term should pull through it out of any short-term market impact.
Okay, well, just before I sort of wrap up with some conclusions and observations, maybe I could throw one last question at the three of you. And so it's a combined question, really. Are there any other thoughts or comments you want to simply share with our audience just simply about the environment that we're in? And specifically, do you have any thoughts on this question related to currency, the US versus the Canadian dollar over, let's say, the short term over the course of the rest of the year? So again, maybe Rob, we can just come back to you to start with on that.
Well, I mean, I think the overall comment I would have is something, John, that you went into in your talk, which is diversification. I mean, it's a tough environment, but diversification, I think that's where diversification really becomes even more important, to have exposure into different markets and try and balance off some of the risks that we see in the world, which are long. On a currency point of view, in the Canadian dollar, I don't know that I see a lot in it right now, meaning I don't see the Canadian dollar being dramatically over or under value. There's a couple things working in the Canadian dollar's favor. One is oil. We know that the Canadian dollar has some sensitivity to oil, and oil is very high, so that's putting upward pressure on the Canadian dollar. The other thing is, it's likely the Bank of Canada is going to start increasing interest rates, maybe even before the Federal Reserve, and that would again be favorable to the Canadian dollar. What may be working against the Canadian dollar is something to consider with the diversification of our economy, and that is our exposure to housing, into real estate, and maybe how sensitive the Canadian economy would be to higher interest rates from that perspective. And so whereas we feel the Bank of Canada is going to have to tighten, there becomes a limit to how much they can tighten given the amount of consumer debt that Canadians have.
Yeah. Okay. Thanks, Rob. So, Mark, what are your thoughts?
I can't really speak too much to the currency in that, because we have a Canadian income fund that's pretty straightforward, and we have a U.S. income fund, and they operate independently. The value add fund is the only one that works cross border, and I'm not sure that really comes too much into play. It's really where the opportunities are. It will impact from time to time if the dollar moves. But in terms of where we see the opportunities and what we're focused on, is really our strategy is to really concentrate on markets that have strong growth and friendly tax environments and access to labor. I think those are really important things for us. And we've identified very specific cities in Canada and the US to concentrate on and implement our cluster strategy where we can build a strong presence. We also are aligning ourselves with local partners in those markets who are and service providers who can make sure we're fully informed at the local level. And so due to our acquisition track record that we're really benefiting from seeing a high volume of these off-market quiet deals where I think we can acquire assets in any environment at a much better values that are going to be very accretive to our fund. When I look at our competition, institutional and pension funds, they typically look to acquire properties that have been listed and underwritten to perfection. The only problem with that is generally these assets are usually very expensive and the returns will not work for our fund. So in our view, those buyers are paying a very high premium, but they're happy to accept those low returns because their expectations are lower than ours.
Thanks, Mark. Michelle.
Yeah, I also don't have a strong view on the currency. But, I think Rob's slide earlier was interesting, where a lot of volatility right after COVID, vaccine comes out, less volatility. I think this year we'll see more volatility. I think it'll be a lot about the year of resiliency. So, be resilient in everything we do. If it's our investment thesis, continue to believe in the things that we believe in. The partners that we choose partners that aren't going to react to short-term market swings and be forced into decisions because they don't have strong balance sheets. So those are the types of things that we're going to continue to look for. And I think we may, as we do our stress testing on investments, go deeper into those areas to make sure that investment partners, sponsor companies that we partner with, they've got resiliency at the top of their mind, and they've got balance sheets to withstand some volatility that I think we're going to see in 2022.
Thanks very much, Michelle, and thanks actually both Mark and Rob as well. It's been great, really good content. Just for the listeners for the podcast, we will be having our strategic outlook this year again virtually, unfortunately, because of the realities of COVID. It'll occur around the beginning of March. Dates will be sent out not too long from now. And we'll be able to do an update on some of the things we're talking about today, seeing how things have turned out. If I had to summarize what I heard today and what I also feel is part of what we see in the marketplaces, I would say maybe a short list of things would include that we should and could expect to see some softening in inflation. But as Rob points out, it's not likely to go down to the rock bottom levels that we may have experienced over the last 15 or 20 years. So there may be some elevated levels of inflation that are going to impact, obviously, interest rates and growth rates as well. Markets have already corrected in most areas of the world, but interestingly, with a huge amount of volatility. So today alone, the markets just closed back east, and the Dow today managed to go from being down 1,000 points to closing up 100. So it gives a sense of the manic aspects of the marketplace, and that is a precursor for increased volatility. And that, unfortunately, where that creates some potential damage to returns is it changes the way investors behave. The more volatile the markets are, the more likely they are to react in a negative way. suggesting that interest rate increases will occur, but may moderate and may be stretched over a more extended period of time, depending on economic output and other factors related to inflation. But the theme for all of our asset groups is active investing, and in particular looking for places to add value where it will make a difference, giving us a better margin of error in each of these asset classes. The overall framework of what we do is based around our asset allocation model. And that model is based, give or take, kind of a third between the three major categories. The thing that makes that really work well is that we have to have the discipline to rebalance, meaning that on a regular basis, whichever asset class has the largest drop in its overall value, if it does have a drop, that is the asset class that you want to rebalance into. The studies that we've looked at indicate that one aspect alone, rebalancing every 3 to 6 months, can change returns over an extended period of time by 1 to 1.5% a year, which is very material in terms of long-term returns. The overall approach that we're taking is more or less defensive, more focused on income generation and less reliant on capital gains as well. Some other factors that are important are that in certain private assets, I would say both private equity and private debt, that their equivalents, let's say in most public stocks and certainly in high yield bonds, the returns over the last 5 years have actually been higher, and there is a reasonable assumption that it will continue to be higher. So even though private equity, for example, is at relatively higher levels of valuation multiples than it historically has been, it's still at least 35% below the current multiples in most of the public markets. So with that, we want to thank you for taking the time to listen to our presentation today. You may or may not have specific questions for any of the people that have been on our presentation. And if you do, please send them in. Otherwise, we look forward to seeing all of you in our formal Outlook presentation in early March of 2022. So thank you again.